Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Jess and Tom Keene with you, and you get started. Torsten Slok joins us. For the Street, the ex-Deutsche banker puts out a note 9-ish o'clock every morning, maybe 8-ish, which is a single paragraph, 2 paragraphs, and 1 chart. It is read by Global Wall Street. Torsten, thanks for joining us for the entire half hour. We'll do some hurricane stuff here in the middle here. This is so serious for Tampa and the Gulf. Torsten, what's your chart this morning? What's the number one thing that's on your mind at Apollo?
So, well, the chart this morning is showing that 26% of power consumption in Virginia goes to data centers. So the need for investment in renewable energy, the need for investment in data centers, the need for long-term capital to invest in long-term projects is clear, and including in boosting here the AI revolution.
Why can't Google buy their own utility?
Well, some of the tech companies are actually building their own power plants and building their own power sources. But the bigger issue, of course, continues to be that, as we all know, one search on ChatGPT takes 10 times as much energy as one search on Google. So therefore, with everything that's going on everywhere in AI, large language models, things getting more complicated, processing power is needed. There is certainly a very substantial need to power the AI revolution, and that does require long-term capital to finance these, including data centers.
Torsten Slok and Jess Menton on the same page. She's writing about this morning for Bloomberg. Jess, let's complete your story. Questions for Torsten Slok.
Well, you were talking about how the risk to cutting interest rate too much too quickly is, especially on the back of the latest jobs report, could become, and especially looking at inflation, might be too hot again. Expand more on that, because we're going to get an update on CPI later this week. Yeah,
this is very important. So the key question really is, why is the economy still so strong? Your textbook would have told you that when the Fed started raising interest rates in March of 2022, the economy should have begun to slow down, because when interest rates go up, people should be buying fewer cars. That's not what we have seen. When interest rates go up, you should have seen the housing market slow down. That's not what we've seen. So there's a number of tailwinds to the economic outlook, from AI, from defense spending, from fiscal policy, the CHIPS Act, the Inflation Reduction Act. All those things combined have kept the economy afloat, including also that consumers were less sensitive to interest rates because they had locked in mortgage rates at very low levels. 95% of mortgages are fixed rates. So because of these very special forces, we've just not had that slowdown that the Fed has been looking for. And we think these forces will continue. So therefore, the answer to your question is, we still think that the economy is doing fine. There is no need for the Fed to lower interest rates.
And you made a bold call earlier this spring that the Fed wouldn't cut interest rates this year. What changed?
So we actually still think that that was and is the right call, because now we're debating, was it a mistake for the Fed to cut rates 50 basis points? We just saw non-farm payrolls on Friday. It again shows that there is no need to lower interest rates. So this raises the question, why did the Fed lower interest rates? And this, Tom and I have been talking about this for years, because they have an R-star model, a framework, which says that, well, our long-term interest rate needs to be lower, so therefore we need to lower it, not because of the incoming data, but really because we think in the long run we should have a lower level of rates. So yes, it is true that they did cut, and our expectation is that they may even also cut here in November. But given the incoming data, the risks are rising now that we may have more upside risk than downside risk to the economic outlook.
Torsten, I want to bounce off your continental view of years ago at Deutsche Bank. To me, the great differential here, and becoming ever more evident each and every day, is the nominal GDP difference between Europe, say, and the United States. I got 4%, even 5% nominal working in the US. Europe's pretty much flat on their back. Is that because of our debt buildup? Are we our grandchildren essentially funding our nominal GDP?
Well, the US has some tailwinds that are rather unique to the US. We have an AI revolution in the US. We don't really have that in Europe. We also have significant support from the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. We don't have those tailwinds in Europe either. And on top of that, Europe has now some headwinds, of course, from energy transition, from the challenges, more broadly speaking, that they have with the economy with low productivity. They have some challenges also with elections in Germany and in France that have created a little bit more complicated political situation. So broadly speaking, the US has some tailwinds, Europe has some headwinds, and that's the reason why Europe still is unfortunately having a weaker outlook for growth.
So you're having a cup of coffee with Rowan and Zelter. I know you're not on speaking terms with them, but let's presume you're doing an 8:00 meeting with the fancy people at Apollo. What are you advising them about the general market, the tone of our equity markets?
Well, we talk every day, and the advice, of course, is here still that the economy is doing just fine across the board. A wide range of indicators. We are seeing that if you look at the daily data for how many people fly in airplanes is still very strong. The daily data from my Bloomberg screen for how many people go to restaurants is also very strong. The daily data from my Bloomberg screen on debit card transactions is also very strong. The weekly data for how many people go to the movies, go to Broadway shows, retail spending is all very strong. So that's basically telling you that, broadly speaking, there is no recession. There's no sign of a recession. GDP last quarter was 3%. Atlanta Fed GDP now for this quarter is 2.5%. Where is this slowdown everyone is so worried about? So it's not surprising that non-farm payrolls continues to be strong. So the advice really is that look at the data that comes in instead of looking at frameworks for thinking about where we might be theoretically with our STAR and the Fed funds rate in several years' time.
What's the top question that you're getting from clients, and how do you use that as a potential sentiment gauge?
Yeah, a very important question is, of course, financing and financial conditions. Financial markets are very easy with the stock market, as usual, close to all-time highs. Credit spreads very tight on IG, high yield and loans. And likewise, when it comes to financing for companies, there is a general trend of debanking where financing is moving away from the banking sector, moving to long-term stable financing capital sources. And those types of financing, of course, are beginning to play a bigger and bigger role because there is a change in the financial system that's beginning to be much more pronounced and play a more significant role when it comes to providing financing to consumers and providing financing to firms. So this debate about how is the financial system changing, both in terms of how we save for retirement, also in terms of how consumers borrow, how firms borrow, and also in terms of the role of banks, is playing a very important part of my conversations with LPs at the moment.
Torsten Slok with us with Apollo Global Management. We continue a good conversation here. Torsten, if we don't get the rate cuts so many people are modeling, what does that do to our economy? Is it something that we have to work out and work through? Or is it just another day at the races and we normalize at these levels?
I like that description, another day at the races. So I do think that this is a very fundamental question, namely, if monetary policy really is restrictive. The Fed keeps emphasizing and saying the Fed funds rate, which today is about 5, and in the long run, we're going to down around 3. Well, given 5 in interest rates is higher than 3, then the definition, according to the Fed, must be that the monetary policy stance is restrictive or constraining on economic growth. But that's not what non-farm payrolls of 254,000 is suggesting. That's not what a declining unemployment rate is suggesting. That's not what a declining default rate for levered loans is suggesting. So if it really were the case that monetary policy was restrictive, as the Fed has been arguing, why is the incoming data then still good? So therefore, Tom, to your question, if they do not cut, we should expect that these tailwinds from AI investing, from energy transition, from the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act, government spending, and generally less sensitivity to interest rates for consumers and firms because they have locked in low interest rates, we should expect these things to still provide a tailwind and therefore make the U.S. economic outlook stronger than what we see elsewhere in the world because of these idiosyncratic forces that we're seeing in the U.S.
After that blowout jobs report, Bank of America was making a call about how CPI is no longer a non-event, and the implied move right now in the options market for CPI day is about 1.1% in either direction for the S&P 500 versus about a 70 basis point move over the last 3 months on that day. So how vital is it when it comes to this latest report coming up in a few sessions here as far as what it means for the Fed's next rate decision?
Yeah, this is a really important question because think about it. For years, when inflation started going up in 2021, 22, all the debate was inflation, inflation, inflation. Now, when inflation there has come down much closer to 2, we're at 2.5 today. We were at 9 in 2022, so we are very close to 2 now. The pendulum swung back to, well, now you know what? It's all about unemployment, because we can check off the box with inflation and say, let's not worry about that anymore. But because we now have this risk that inflation could potentially begin to move higher, it is almost as if the pendulum is about to swing back towards inflation again. As you're saying, that's not how markets look at Thursday's data that's coming out on the CPI. But it still is very important here that the different focus from the Fed, sometimes it's inflation, now it's been unemployment. Well, now we're back to watching if inflation actually is on its way back to the 2% target, or if there's a risk that in particular, the 40% of the CPI basket that is housing, if that begins to move higher again, then we will certainly have much more focus back on inflation again.
And of course, when you're looking at the money market funds still being around records here, if rates do stay a bit elevated, what's the actual yield based on history as far as when you'd see money coming out of money market funds and more going into the equity market?
Yeah, and this is the real Sherlock Holmes mystery looking ahead, namely the more than $6 trillion in money market funds. A lot of that money came into money market funds because the Fed funds rate went up. Now the Fed funds rate is going down. So the question is, what are investors in money market funds going to do? Historically, they have gone into other types of fixed income, IG credit, some high yield, maybe some loans. But the question is, might they even take some of this and put it into equities if the Fed continues to lower interest rates? In other words, what is the risk willingness of that $6 trillion in money market funds? Where do they go?
Yeah, this is brilliant, Torsten. Jess, great question, because this is just the heart of the matter. But it's nonlinear, Torsten. We just had a model. What did you learn in the lower interest rate experiment of the last 12, maybe 16 weeks? What's the lesson you took away?
Well, I think a lesson is exactly something that we can get from what happened for the 14 years from 2008 to 2022, when interest rates were literally at zero. Well, in those situations, when we had investors with a lot of money that gave much lower in return in rates, they began to chase yield. The hunt for yield, of course, resulted in a rally in a broad range of asset classes. And it also, in this case, will likely result when the Fed now embarks on lowering rates. What we're debating is the speed with which they're lowering rates, not if they're lowering rates. So even if they do lower a little bit slower, as I would expect, I do think that this will be positive also for credit. It will also be positive for equities. It'll be positive for asset classes that generally benefit when interest rates move to lower levels. But what's most important in this debate is that we are not going back to zero. We will have, according to for futures, the Fed funds rate at around 3 to 4% for the next 5 to 7 years. And that does mean that fixed income, including private credit, is looking more attractive because we had a very different environment when interest rates were zero relative to now when interest rates are between 3 and 4.
Torsten Slok, Michelle Bowman gets a massive victory lap. You grew up with the descent of the ECB, the descent of the Bank of England. Should we see more Michelle Bowman-like dissent at the Fed?
I do think that this is a healthy development. Not that they shouldn't all agree all the time, but I do think that in particular in this instance where we are exactly debating, well, maybe the 50 basis points cut, which was really justified by a recalibration. Remember, Jay Powell mentioned 10 times in the press conference that the reason why they did this was to recalibrate monetary policy, not because the incoming data was weak. I do think that there is now a healthy debate among FOMC members. We heard from several of them yesterday that, hey, maybe we should go a little bit slower. Maybe we should watch the data a bit more carefully. And I do think that, therefore, dissents are probably a more pronounced feature of FOMC meetings over the next several quarters.
Can't wait, Torsten, for you to be appointed a governor. Mr. Slok is with Apollo. Thank you for the generous time here. I had an uncle who's a professor at Union College in Schenectady. When my father got angry at me, he'd say, spell Schenectady, which I never could do. Jennifer Lawless could spell Schenectady. She survived winters there. What was it like at Union College a few years ago, Jennifer Lawless?
It was so many years ago now, but it was snowy and cold.
It was cold. That's what I remember. On the Mohawk River, it was mostly cold. Jennifer Lawless out of Union and, of course, Stanford, and now holding court at the University of Virginia. She's absolutely definitive on the female species in our political moment. Professor Lawless, how is the Vice President of the United States doing in garnering the votes of women?
She's doing as well as most Democratic candidates do. Most people think that when there's a woman at the top of the ticket, there's a bigger gender gap. But the reality is that female voters tend to prefer Democratic candidates. Male voters tend to prefer Republicans, and the sex of the candidate doesn't matter that much in terms of vote choice. But what Kamala Harris is doing is really motivating women to turn out. And ultimately, It's likely going to be a turnout election.
Which is the key female turnout? Is it the women of the suburbs of Philadelphia and Pittsburgh that we heard about 2 years ago and 4 years ago? Or is it a different distinction of women that she needs to win?
I think it's two groups of women. It's the suburban women for sure, because in battleground states, they're often decisive. But it's also motivating young women who need to turn out if Harris is going to not only build up her popular vote, but also secure wins in tough states. And young people have traditionally been less reliable when it comes to turnout. So anything she can do to make sure that young women are enthusiastic will be very helpful on Election Day.
So which states are going to be most crucial for the female vote?
Well, basically, the female vote is really important in all states because when the Democrats are able to ensure that they have greater margins among women, they tend to win. So if she can up the female vote, if she can increase her margins in blue wall states like Michigan, Wisconsin, and Pennsylvania, as well as along the Sun Belt, those are two good paths to victory. Without a big advantage among women, it's hard to see that happening.
And as far as when it comes to those swing states, which ones do you think are most crucial? Because you named a couple there, but do you think it'll really come down to those?
I do. I think without winning Pennsylvania, it becomes very, very difficult to win the election, especially given the amount of time that she's been spending in Pennsylvania, that Walz has been spending in Pennsylvania, and Joe Biden's connections to Pennsylvania. So I think that's the most important state. And if she wins Pennsylvania or plans to win Pennsylvania, the easiest path to victory is then through the blue wall states of Michigan and Wisconsin.
Jennifer Lawless, I want to go back to your core research here, which is in so many other countries, we seem to be very comfortable with women in any number of slots, whether representative, senator, even at the local level as well. You know, the work you've done at UVA, running for office is still for men. How did we get there? Why are we distinctive in this?
It's interesting. It's really a supply problem and not a demand problem. And by that, I mean that when women run for office, they generally fare just as well as men. They're just as likely to win their elections. They raise just as much money. Their media coverage generally looks the same. And keep in mind, in 2016, Hillary Clinton did win the popular vote. So voters, donors, and the media seem okay with women. The problem is that women are still significantly less likely than men to emerge as candidates and run for office, largely because they perceive that there's widespread systematic bias against them. And so it's sort of a chicken and egg problem. If we don't have enough women out there, we can't normalize it for more women to start emerging.
So what do you think ultimately needs to be done in order to fix that?
Two things. The first is political recruitment. When women are encouraged to run for office, either by a party leader, elected official, or political activist, but also by a family member, colleague, or friend, they're far more likely to give it serious thought. And if you don't think about something, you're not going to do it. So that's an important first step. And the next thing that we have to do, I think, is convey the reality that when women run, they are just as likely to win. We hear high-profile stories about gender bias and discrimination all the time. And those things are true and they do happen. Right. But part of the reason that they're newsworthy is because they're rare.
Professor Lawless, I believe in the Wall Street Journal today, I don't have it in front of me, there was a pithy article about Democrats in Michigan basically saying to the vice president, let's go lose the media dash and get up here and campaign. Where do you stand on that? Does the vice president, President Trump has a mode, he has a model, and he grinds it out every day. Is there a mode, is there a model to Harris, or does she need to shift now 20x days before the election?
I think she's got to walk and chew gum. We saw in 2016 that Hillary Clinton wasn't campaigning as actively as a lot of people thought and turnout wasn't where it needed to be. But we've also seen people like Joe Biden take a hit for avoiding tough questions by journalists and doing these media tours and blitzes. So I think the Harris campaign is trying to do both, and she's got 28 days to demonstrate that she's able to do it.
Jennifer Lawless, thank you so much. Greatly, greatly appreciated. I really can't convey enough the theoretical foundations of Jeffrey Rosenberg. He comes on the Fed day, he comes on other days, and for BlackRock, it's blah, blah, blah on the fixed income market, over to economics, even with a touch of equity analysis. But behind it is Minnesota, Wisconsin, and then on to Carnegie Mellon. It is rigorous mathematics behind the Jeffrey Rosenberg comments. Jeff, what part of your mathematics matters right now? On a basic equation of where we're heading, what's your number one focus?
That's a great question, Tom. And the answer is rate of change. And that's really what markets focus on. They focus on, much more than the level, the rate of change. And that's really what last week's economic data and really before that was all about, right? The rate of change in the actual data. And as importantly, the rate of change in the revised data. And so that's really changing people's perspective about where this economy is and where the Fed has to be. And that's what you've seen in the bond market the last 2-3 days. And it's pretty violent, this rate of change.
To me, what's important here with first, second derivative Newtonian mechanics is a basic idea, Jeff Rosenberg, that it's simple chug and plug. I mean, what does Jerome Powell need to plug into the equation to lead us to some stability for, dare I say, a vision out to late 2025? What does he need to do?
Yeah, it's an interesting question because there is a lot of, kind of taking the SEP forecasts for growth and inflation, plugging those into a formula, various variants of the Taylor rule, and determining whether or not the Fed's policy, excuse me here for a second, is overly restrictive. And the problem is the inputs to those formulas, they change, right? And that's a big part of the recent, kind of reassessment here in the bond markets, really all the financial markets, that the data has been revised. And the data, particularly on labor markets, the data in terms of the consumer and the broad economy, the debate between GDP and GDI basically was settled in favor of GDP being the right measure, meaning this economy is as strong as it appears and not this kind of sneaky weakening. And so the data going into those formulas is changing, and it's basically saying, the Fed is not as restrictive as it thought it was.
And so in that case, on the back of this latest jobs report and ahead of the CPI data later this week, what is speculative trading in the futures market for bonds telling us about the direction of yields?
Well, you don't have to look at the futures markets to see what the trading is saying. It's basically spoken pretty clearly here, and I think you highlighted it in the break a minute ago. That we priced out the expectation that we were going to have 350 basis point cuts in a row, and now you've backed off that pricing to November's 25. It's actually a little bit underneath the 25, and then another 25 in December. And so you're back to a little bit more of the bond markets aligned to what the Fed was saying, whereas before, and really much of the year, the bond market has been just very much aggressive, kind of overreacting. Obviously we came into the year huge expectations for a lot of cuts. We had to price that out given the inflation level. And then,
as we head into the final months of the year, how are you suggesting to clients, what do they buy, what do they sell in the treasury market?
We've been, pretty adamant that the vulnerability in the bond positioning for most clients is what we've been seeing a lot in the flows. And what you see in the flows is this kind of knee-jerk reaction to the expectation of the commencement of the Fed's cutting cycle. And the knee-jerk reaction is, if the Fed's cutting interest rates, then duration is my friend, and I want to own the maximal amount of duration in my portfolio. I want to own the longest maturities out there. And that we've really been very much saying, you got to be careful. Number one, it's a little bit of buy the rumor, sell the news. The Fed cut 50 basis points and bonds lost money. So a lot of it was already in the price, and you had a lot of heightened expectations. And number two is that you just have a differential reaction along the maturity spectrum when the Fed cuts rates. It's mostly in the front end where you see that impact. And the back end can be affected by a lot of different things besides just the Fed cutting rate.
I'm going to go a little mathy here. Math warning. And Jeff, it goes off of what James Glassman said yesterday, retired from JP Morgan, about the technology overlay. All the work you've done, Jeff, and how it folds into the bond market is off of a productivity analysis, off of technology. And I would suggest off the foundational Cobb-Douglas function, which has some exponents. It's got some Greek letters in it. But there's a big, fat, ugly A at the beginning of the Cobb-Douglas function. And that's sort of like, where are we now? Well, it's like, okay, this is the technology. This is the economy. We're going to do the math, but we really don't know where are we now. How blind are you, Jeff Rosenberg, in working in fixed income at BlackRock because you don't know where we are right now on productivity or technology?
Yeah, the Cobb-Douglas production function. We can measure what goes in and we can measure what comes out. It's the magic inside that we don't know about. That's total factor productivity. It's interesting, Tom, you talk a lot about, the math and the science that we use. And a lot of the math and the science that we use is the mathematics of uncertainty, right? It's using probability and statistics and risk models to try to quantify uncertainty, because that's really what it's about. The Cobb-Douglas function is nice. It gives you a very certain form with a very uncertain input. And that's a lot of what we see in kind of the mathematics of economics, is that there's a proposal of how the economy works. And it's very nice and clean. The problem is a lot of the inputs are unknown. And that's really what we're dealing with, whether it's kind of the role of AI, the role of technology in changing total factor productivity and our inability to measure that, or other things that we were talking about before, in reference to the Taylor rule. The other, kind of big uncertainty is, the real neutral rate. We don't know what that real neutral rate is, or something even more, kind of basic, which is we measure economic data that we think we know with certainty, like growth and inflation, or payrolls or employment. We measure it with error. So when there are revisions, there's a lot. So it's really about dealing with that uncertainty. And I think on this technology issue, we really just don't know. What we really see in terms of technology, the impact is this first phase, which is the investment side, and the tremendous kind of infrastructure build out. But it's really kind of the second phase, which is the services on top of that. And then the third stage, which is you have the services that are expanding the impact of that AI, that really builds into that fundamental game shifter that many are talking about here, is the potential for AI to shift upward the total factor productivity. But to say that's in the economic statistics today, I think it's too early for that. What we clearly see is this first phase of the investment spend.
I can't emphasize enough, Jess, and everybody knows where I am on this, is L. Arian would say, the unknown unknowns right now that Jeff brilliantly laid out there. The financial media, I'm as guilty of this as anyone, we are certitude 101. We believe the 10-year yield. Baloney. I'm sorry, we have no clue when you look at these variables like technology.
And this time a year ago was actually when the 10-year Treasury yield spiked around 5% to that level there. If you look now, it's trading at around the 4 level after being around 3.6. But of course, if you're looking at the Atlanta Fed GDP Now model, it's around 2.5% for the third quarter. So I'm curious, why had bond yields continued to creep lower this year despite sturdy economic growth?
They went lower on a number of factors. The biggest thing, was this fear, this slowdown, right? I mean, we had a lot of conversation about the unemployment rate ticking up, the SOM rule predicting a recession, a lot of recession fears, and that, pushed, and we got, I would say, the kind of impact on that was, the big 50 basis point start of the cutting cycle is very much built off of this kind of legacy of the late summer slowdown in the labor markets. And now when we look back on it with the revisions and the data, the residual seasonality story around initial jobless claims, it's all kind of pointing to maybe this labor market is a lot tighter than we thought it was. But I think the big drop in the yields was because we had this recession fear, and the jobs market and the labor data kind of supporting this notion that the shift from the focus on inflation to the shift on securing the soft landing meant the Fed had to be very, very aggressive. Right. And that's where you got yields coming down so aggressively.
And do you still see and are keeping your call of 225 basis point rate cuts for the remainder of the year? For obviously, we have 2 more meetings left in November and then in December.
Yeah, I said that kind of at the end of Friday, post payroll, that, the easy call was taking the 50 out for November. I think they're going to want to stick with 25 and 25. Obviously, we've got some more data between now and then. And, critically Thursday, this inflation report, we've moved inflation to the secondary category of importance because of the, I would say, erroneous belief that the attainment of 2% is just a given. And so I think if you had some surprises on inflation, you can't really predict that. That's the definition of surprise. You could change the narrative around the 25. But right now, not knowing, whether we're going to get that, I think the Fed's going to try to continue to deliver on 25 and 25 in November and December. And that's where I would, be expecting. But, the data changes, we're going to have to change our minds.
Jeff, this has been brilliant. Thank you so much. Jeff Rosenberg with us at BlackRock. This is a joy. Greg Giroux, and the only one close is Dave Wasserman at Cook Political Report, is the granularity of America away from all the endless news of 2 candidates and that. We are thrilled that Greg Giroux of Bloomberg Government would take time with us this morning. Greg, you're focused on Washington State, Republicans, and you're focused in California on Democrats in a 2 at the top outcome. Explain that.
Yeah, so in some states, it's possible for 2 Democrats or 2 Republicans to advance to the general election because they have unusual primary systems. Everyone runs on one ballot in the primary instead of in separate Democratic or Republican primaries. And the top 2 vote getters in that single ballot race advance to the general election, regardless of party affiliation. So in states like California, Washington State, and even in states like Louisiana, it's possible to have 2 members of the same party compete against one another in the general election.
It even sounds like 1780 or 1790, almost. Greg Giroux, how is the left, the liberals, the progressive doing nationwide? Do they have traction in this election?
Yeah, I mean, I think they probably cast their lot in with Vice President Harris in the presidential race. You have 2 choices. The left is going to by and large back Vice President Harris. I mean, there are always going to be some disgruntled people on the left and the right who are going to maybe not vote, but I think there'll probably be a decent voter turnout in this election. In the Senate, I think it's a bit different in that control of the Senate may come down to not what progressives think, but what some Trump voters in Montana think, because I think the tipping point state for control of the Senate right now is Montana. And if John Tester, the Democratic senator there, can win enough ticket splitters in his state, which is going to vote for Trump by about 15 to 20 points, he needs so many Trump voters to split their tickets and back him. So, progressives will be very, I think, more important in the presidential race and in some down ballot races for the House.
Right.
But in the Senate, while they're important in a lot of these swing states, watch Montana and what these Trump voters do.
One state I wanted to bring up is Texas, because you've written about how it's offering Democrats the best shot for a Senate upset. Walk us through the dynamics here and what's happening.
Yeah, so in Texas, Senator Ted Cruz is seeking a 3rd term. Texas has not elected a Democrat in a statewide election since the 1990s, has not voted Democratic for the Senate since Lloyd Benson in 1988. Wow. But Democrats have come close, including in 2018 when Beto O'Rourke, who was Cruz's challenger, came within 3 percentage points of beating the senator. That wasn't a good Democratic year. Texas, now we're in a presidential election year. Trump is almost certainly going to carry Texas, maybe not by a wide margin, but the margin in Texas 4 years ago was only 5.5 percentage points. So it's not a blowout state for Republicans anymore, but it's still going to be very tough for Colin Allred, the Democratic congressman who is Cruz's Democratic opponent, to get from, say, 47% to 50% plus one.
Greg Giroux and Nate Cohn had that article 2 days ago, I think, in the New York Times, and I'm going to center it around the New York congressional race, the surprise of 2022. Do you frame the Greg Giroux work as a continuation of what we saw in 2022, or is 2024 really discrete and presidential?
Well, I think 2024, in the race for the House, New York is the state to watch, New York and California, which makes it kind of different from the presidential and Senate election maps, which have a lot of overlap in, the industrial Midwest and in some competitive Sunbelt states. When we were looking at control of the House, yes, I'm looking at a lot of my 2022 notes in New York. You have some rematch campaigns there, and it's going to come down to Harris's margin in New York is going to be important. Biden carried New York by about 23 points 4 years ago. It looks like Harris is not going to win New York by that much, and therefore, those Republican congressmen seeking re-election may not have to win as many ticket splitters as they did before. But the disproportionate number of competitive seats for the House are in New York and California.
Greg, one final question. What's the single race Greg Giroux is most focused on?
Wow. Well, I think the Montana Senate race for the reasons we mentioned earlier, but also, I don't know, I think I'll pick New York's 19th district. Since we were just talking about New York, Mark Molinaro. This district runs from Ithaca east through the Catskills, some of the upper Hudson Valley, all the way to the past Albany. It voted almost exactly for Biden and Trump as the nation did. So it's a very good, I think, bellwether as to which way the political winds may be shifting this year.
Greg, this has been wonderful. Hope we can catch up with you on a weekly basis here as we dash to November 5th. Greg Giroux, folks, for those of you within Bloomberg Government and available on the Bloomberg Terminal, I can't say enough about Greg Giroux. His newsletter, Ballots and Power, is absolutely must read. I can't say enough. Sign up for that as you're able to. Greg Giroux with Bloomberg Government. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.